Hi, and welcome to our 2022 Real Estate Predictions Podcast. Hey, everybody, welcome back. Here we are, January the 1st, 2022, and Ryan and I are here, and we are excited to bring you what we think is going to happen in the 2022 real estate market. We've got all our predictions across the board, but first we're going to obviously touch on what is going to drive all of our predictions. What's happening out in the economy, what's happening with coronavirus, etc. So we're going to kind of frame up big macro view of what's happening here, why we think prices and everything are going to go the way we do. And then we are going to unveil those numbers. So first, Ryan, I think we'd be hard pressed not to touch on the coronavirus numbers. And of course, the main reason that we need to touch on it is because we know what happened in the last basically almost 2 years now because of the coronavirus. And what we mean by that, of course, is all the lockdowns that resulted in all this stimulus, that resulted in all this extra money, a 3-to-1 overpayment by last calculations. And that also drove people indoors, which said, okay, maybe I don't like where I live. So then they started moving. Here we are 18, 24 months later, we're up 30, 40% in some areas since then. And what's wild is, at latest count, we are something like 20 times higher the daily infection rate than we were when we shut down originally. So it's a very different time. Yes, there's vaccines. Not sure how great they're working for some people, but let's kind of touch on what we think will happen with coronavirus as far as it will affect the market in 2022.
Yeah. Sorry. Yeah, the coronavirus is getting around. There's no doubt about that. And like Dan said, all-time highs in terms of numbers, broken record. Thankfully, I think with Omicron, it's not as potentially lethal as some of the other strains. So I think while we're experiencing incredibly high numbers, and we have seen, gyms and public gatherings and things like that all come to an end. I do think it's temporary. What's going to be really interesting to see is if Omicron goes through the population and actually helps create a whole new level of resistance, which will maybe quicken things, get back to normal. I mean, who knows? But at the end of the day, I find it interesting that we're seeing higher than record high numbers in terms of transmissions, and yet we haven't really seen a huge. People aren't all of a sudden thinking that real estate is going to bump another 40%, right? I don't know if it could, but without a doubt, the coronavirus will have an impact. I don't know if it'll have the same level of impact. Just as we continue to learn more and more about this disease or this virus, we will continue to adapt, and so will the markets. And so, it won't go on forever. And I think that the big boost was 2021. I think 2022, I think things will maybe return a little bit to a bit more of normalcy, because we'll be able to anticipate lockdowns a little bit better. We'll be able to anticipate, we know that new variants are going to happen, right? So, what are inoculations going to look like? Are there going to be new vaccines? I don't know. There's a lot of potential what ifs with the coronavirus. But I think that the markets are now baking in some of that potential what ifs. And I think that's where things are a little different than the last probably 20 months. I don't think we knew how to bake in the numbers with coronavirus. I think now we're getting smarter about how that might happen.
I'm going to largely agree. I think the biggest change this time around is I don't think the lockdowns will be as exponential as they were first time around. I don't think we're going to see across the board shutdowns. They're still being spotty, and they're, targeting certain industries. And as unfair as that is, they're not throwing blanket rules across an entire city or nation. And because of that, of course, they're not going to stimulate as much. I don't think we're going to see another 20, 25% of new money pumped into the system next year. We're just not. I don't even know if we'll see, 4 or 5% kind of max, based on, this staying relatively under control to a point where they don't feel a need to completely shut down whole countries.
I didn't do my M2 money supply projection for this. That being said, they're going to be printing money. The question is how much,
Yeah.
right?
Again, pull it way back from last year. Way
Yeah,
back. Again, I don't
completely.
think we're seeing double digits. Again, I would cap this around 4 or 5% is my prediction today.
Yeah, I tend to agree. I think that's assuming all things remain the same. There's a lot of variables at play right now. But yeah, I can go with that. So Dan, why don't we start talking about some of the main drivers here? Because coronavirus is definitely it could be a driver, and it could also stop things pretty
Mhm.
quick. But let's maybe talk about if if we continue to progress, we continue to move towards a more stable, open society as we know it. What does that mean for immigration? Right. Let's start with immigration because I think that's probably where uh, well, next to money supply immigration is your demand, right? So we need to know sort of, do we think the country is going to continue to hit its numbers? I mean, we thought that they were going to hit about half of their numbers last year, and lo and behold, they hit their numbers in November. I will never bet against the man again.
And by numbers, we're talking about their targeted 401,000 new permanent residents into Canada in the year 2021, which, as Ryan just mentioned, they absolutely hit that number by the end of last month. They had a whole nother month on top of that. And when the data comes out, I'm sure we're going to see a higher number. So, yeah,
Yeah.
will they hit their targeted 411,000 in 2022? I mean,
Yes.
yeah. Agreed. They've clearly shown they're going to put the manpower behind hitting those numbers.
Well, you got to think about that from their perspective, the government's perspective. Who's going to pay more tax? New people, right? And they're going to push the demand on housing. They're going to push the demand for more loans. They're going to push the demand for increased money supply. They're a huge driver in our economy, right? So don't discount the fact. I would be very surprised if Canada did not hit its numbers. I would even say it could surge and go beyond what they've predicted. Again, that'll come down. Hopefully, they're talking to city planners with how many homes they're building and things like that, because that's the next thing to talk about if we're going to talk about record high immigration.
Yeah, I mean, let's be open here and definitely acknowledge that most of the PRs that obtain that status already live in the country.
Mhm.
And keep in mind too, the average new immigrant into Canada rents for 2 years before they buy. And a large reason for that, of course, is yes, establishing steady income, a job, filing taxes, and of course, waiting for that PR status to go through. Those are obviously being fast tracked now. Um, we can definitely say from experience that people and our clients are very inclined to purchase a home the minute they get their PR,
Mm.
like right
Mhm.
away. Right
Mhm.
away. That's, we've dealt with what, at least a half dozen probably in the last year or so
Yeah.
of people that, they're ready. And the second they get it, boom. And this is, of course, because they don't want to pay the 20% foreign buyer tax. So as soon as
Funny,
they can buy,
funny
they do.
though. Funny though. We had Simon Bray come on from REW, and he came out. This just clicked in my head. He came on our show and said, had he actually bought and paid the 20% foreign buyer's tax, he'd actually be up now because his house went up by 25% last year.
That's right. Yeah. Yeah.
Anyways,
It
just a
makes
point.
sense in hindsight, though, coming up with an extra 20% in cash, maybe
Ugh.
not everybody's first choice or option, if you will.
Yeah, arguably he got a better mortgage rate by waiting. So
Also true. Okay, so what about everybody who's thought about buying or tried to buy last year and didn't? Where did they stand?
same spot. They don't have a home. And if they're not too beat up, that might be the only thing that would discourage somebody from buying, I think, next year. If they're not too beat up by it, and mortgage rates still remain decent based on interest rates, I think you'll see a lot of those buyers continue to try to get into the market. Um, if they didn't, because the average price of the entry level home grew to a point where they're no longer able to buy, that's a different story. But I think if people were buying inside of a price range, um, maybe they're changing their asset class. They're not buying what they were trying to buy this year, but they could still get into the market. And I would expect a big push from those people first, as they continue their momentum in January, February, and into the spring market.
Let's keep in mind, up until the end of December, the stories of multiple digit buyers, or sorry, multiple offers, like
Mm,
I'm talking double digit multiple offer scenarios, they went right up until the very end of the year.
yeah, yeah.
And of course, what does that mean? Well, sure, one person wins and gets a home, and 10, 12, 15 are still looking the next week. And
But
next week is the first week of January.
Dan, we were in multiple offers in Squamish on the 22nd of December. Like, it was relentless. And that was, that was the norm. There, everything was going into multiples, right? Um, Again, I just don't see that demand disappearing. It's not going to change because Christmas came, or because people went on holiday. I think a lot of that demand is going to be there this time next year. On top of the 401,000 people that got their permanent residence this year, and then the 411,000 that'll be coming next year, on top of the buyers that didn't buy this year. So yeah, I think there's going to be quite a bit of pent up demand. Hopefully the government doesn't squash the demand or tax the hell out of the demand, though.
This was the first year I ever saw a new listing hit the market where the first open house was December 25th.
Wow. I've never seen that. Yeah.
Yeah, me too.
Wow.
So that
Wow.
gives you an example. And I didn't track it, but I would basically guarantee you that it was busy, that
Oh,
people went to it, and that it is probably now long sold. So
sure. Yeah.
it's just, I mean, people are releasing homes this week, right? December 30th, we're recording this. I saw 3 new listings that hit my clients' needs
Mhm.
yesterday, December 29th. I mean, it's very unusual, but again, they know the demand is out there. So
Yeah.
just by releasing it right now, you are potentially avoiding other competition. You're standing out above the rest. You're going to get all the attention.
Interestingly, too, I think historically, whenever you go through a busier year, people often shut down during this time, right? And they turn off, or they're not quite as attentive. Maybe that was the case. Um, and I think a lot of realtors tend to tell their clients that. However, I think every realtor told their client that this year. And that's as a result, we came into, December, guns blazing. There was no slowing down. And I think January will just take off again, with far more buyers than there is available inventory to support them.
Totally. Absolutely agree. Okay, let's shift into the job market right now, because we're in a very unique situation with the job labor marketplace in the sense that we are above pre-pandemic levels for employment levels. So we're sitting pretty there. But on top of that, we have something like 63% of large corporations say they have a net hiring intention in 2022. What does that mean? They're looking to bring more people on. They're trying to hire more people than they're definitely going to plan to let go. And on top of that, we're seeing basically a battle for higher wages because it is so hard, apparently, right now to find good laborers, both skilled and unskilled, that how are you going to entice them? You're going to increase your offering. You're going to offer a higher wage. So we are going to see like a fantastic employment numbers through all of 2022, and then we're going to see people making more money.
Yeah, I tend to agree. I think maybe where my projection is maybe a little different is I think some of it will be in wages. I think the way that companies will stay nimble and competitive in the environment is actually by increasing signing bonuses so that they don't increase too much overhead. Because I think we're in a supply shortage, including people. And I think when that eventually balances out with immigration and all that kind of stuff, I don't think companies will want to stay too attached to high paying salaries. I think they'll go for maybe one time signing bonuses and a marginal increase in salaries. That's just my take on it. But I do generally agree with what Dan's saying, that you're going to see numbers up across the board in terms of employment numbers and in terms of wages. I do think somewhere between 3.5% and 4% is what you'll typically see for wage growth, which is huge considering the average is like 0.3% for the last 30 years. So that's a tremendous increase, which is more than welcome to see. But I think the smart companies will pay signing bonuses. And I think that's how they'll also poach people and retain people.
Fantastic. And let's make this very clear. The number one driver of housing is jobs.
Mhm.
People go where jobs grow. It's that simple. And if we're telling you right now that Canada has net hiring intentions over the 60% mark with increased wages, if you're looking from another country, for example, where are you going to be enticed to move where there are a ton of jobs and they are literally fighting to pay people more? That's
Yep.
Canada right now. That is the
Yep.
landscape. That will attract people, that will attract new immigrants, that will attract people going for PR.
Yeah. Well, we were seeing it. They hit their numbers in November, right? And I think you're going to see it again next year. The other thing then to think about is once those people do make that additional wage, once those people do make those signing bonuses, where are they going to put that money? It's going to go into likely real estate and or the stock market, right? I think that's we saw that this year. We really did. And I think if you throw more and more money at people, as long as their costs are covered, they're going to invest that money.
Absolutely. Now, what about inflation? Because it doesn't
Ugh,
matter how much you're making if it's all being burnt away by inflation.
that ghastly word.
Yes. Um, Pretty lofty numbers here that we're expecting. Ryan, why don't you share yours first?
Yeah, I don't think we're out of the woods yet with inflation. I mean, I tend to think that inflation's still going to go a little bit higher. I think we'll see it hit mid sixes before cooling off. Um, Again, that largely depends on interest rates, what they do, and on the interest rate hikes side of things, right? The big thing with inflation is that your GDP needs to stay in front of it in terms of growth, right? So I do think that if it does hit the mid sixes, it'll only stay there for a short period of time before coming back down. Um, I hope that they get it back in their target range, 2 to 3%, I think it was, but we'll see. We'll see how transitory it is.
Yeah.
And I think we'll see what happens with money supply. I think that's the other big thing.
Okay, my take, they're going to continue to underreport real inflation as they do. I'm predicting a high of 5.8% to be reported. Everyone's going to know and feel it's a lot higher, but that's what they're going to say it caps out at. And that'll be up in that number till the end of Q2. I don't think we're going to start to see that retract until the beginning of Q3. And then, yeah, by the end of the year, it'll be within their 1 to 3% target band. Yeah, but it won't be 1%. It'll
No,
probably
no,
tuck
no.
just under 3% by the end of the year.
Yeah, yeah.
Okay, so
Okay.
then based on that, what is Bank of Canada going to do next year with interest rates?
Yeah, I mean, largely depending on who you speak to and your perspective, I think it's going to depend largely on where they wag the finger. um, it's going to be somewhere between 2 and 5 rate hikes, in my opinion. Again, coming down to how transitory this inflation is and the coronavirus and the shutdowns and all that kind of thing. I think if we get a ton of push on the coronavirus and things remain slow and locked down, I think you'll see very little in terms of interest rate hikes, just simply because the economy will remain fragile. But I think is if things continue to move towards more and more reopening, then yeah, I think you could see 2, 3 interest rate hikes. I think I'm largely with you, Dan, and I don't think we'll see more than 3. I think that would be too. I think that would hamper the economy too much. I think 2 is probably perfect in my opinion, but I think you might see 3 depending on how quickly they notch it up, right? Are they notching it up by 0.5? Are they notching it up by 0.25? I think that's got a lot to do with it too. And I think next year, I think it'll be an incremental return. So I think you'll see 3, and I think
Okay.
they'll either be between 0.5 or 0.25 every time they do it.
Okay, nice. I'm going with 2 total. First one in Q2, second one in Q3, and they're going to be quarter points each time. And that's it. They're going to look to, of course, as they always do, the US and other countries. They're starting to lift in a couple other countries now, and Canada is just going to follow suit. But
Mhm.
it's going to be tough for them to do so. Bank of Canada did basically stick to their promise of keeping rates at the bottom for 2 to 3 years. And so, yes,
Mhm.
it's ultimately going to end up being 2 years. But if they have kept to that promise and their current promise is 2 hikes next year, maybe they've earned my trust and they're
Yeah.
gonna, and I believe what they say. Dangerous, dangerous, Dan. But, but realistically, I think they have forecasted this and they're being quite transparent about what they plan to do. So there's my predictions. There you go. 2 quarter points, one in Q2, one in Q3.
All right.
But what about mortgage rates? What's that going to look like? Because this is obviously mortgage rates are going to be a big effector into pricing next year.
Are we going to see a return of a 3% 5-year fixed? What do you think, Dan?
Not a chance. No way.
So so where do you think that 5-year fixed is largely going to land?
Gotcha. Well, it's going to just outpace the Bank of Canada rate. So I'm predicting Bank of Canada at half a basis point. We're going to see interest rates climb by 0.75.
Okay, I could get on board with that. I really can. I think the banks tend to typically either hedge the Bank of Canada or they try and take advantage of maybe a bit more froth in the market by getting a little bit more than than the bank typically could, and that's for different reasons and different competitive reasons.
Right. Of course, looking at right now, if we're 2.25 fixed, and yes, you're right. It does hit 3. Sorry, I was in variable mode. Variable was going to peak somewhere in around 2 next year.
Yeah. Yeah, I tend to agree.
So there's your, are they going to start to tighten up again? Probably. But let's say they continue their sort of full basis point spread that they're sitting in and around now. That puts your variable at 2 and your fixed at 3 by year end.
And I don't think they'll be afraid to do that. You got to remember, as they went through this year, we went through some pretty stiff mortgage stress testing, right? So a lot of the people that have mortgages have been tested at a lot higher rates. So I think so long as the economy remains hunky dory, that you'll see those they'll start to notch those things in because it's time for them to make some more money, right? A lot of these loans are really cheap right now. So.
Mm-hmm. Okay, so looking to the lip service, the taxation and cooling measures that have been promised.
I didn't see
We
that
laugh
coming.
because we've seen it for 10 years straight. Like.
Yeah. Yeah. So I think I largely think that OSFI is going to come out and really come after investors in the new year. I just want to touch on this for a second because they always get hit. They're always the first ones to blame, and they're the first ones to come in and recover something. And then they're the first ones to get hurt. Like they're not supposed to get a reward for the risk that they took. So, I think you'll start to see OSFI drop the hammer on investors here until until the market, quote unquote, tends to soften a little bit. If 25% of all new mortgages in the marketplace right now are investors, I think they're going to see that as a threat to people who are trying to buy homes for themselves. And because of the competitive nature of trying to buy a home in Canada right now. So I think that those guys will get hit first. And it's sad because if we actually had enough supply, everybody could play, but we don't. And I think that they're going to get hit first, right? I don't know, Dan, what are your thoughts?
Yeah, no, agree with you there. That's a very easy target. And, the government's not going to supply rental housing. So let's just tax the people who do. That's one really good way to suppress housing even further, which is essentially seems to be the MO time and time again.
Yeah.
On top of that, they basically Trudeau was on a platform here where I believe they're banning foreigners entirely next year, or if not, it's just going to be the secondary properties. And again, they're now taxing 1.5–2% of the market. I guess it sounds good on paper, but it's not going to affect a thing when it comes to pricing. It's not going to make anything affordable. I will tell you that right now.
I don't know why reporters don't just pull them up by the collar and say, "Hey, look, you promised us 4 million homes. How many are being built?" Like, it's just distract. Hey, look over here. Hey, we said this. We're going to go after these guys now, create a stink so that you don't hold me accountable to the things that you hired me for. Politics, man.
Yeah, it's
Like you said
upsetting.
earlier, it's lip service, right? And so again, though, we can complain all we want. Our job really is to help you with what's not just likely, but what's probable, right? Not possible, but probable. And I think, if you're an investor, you're going to have to be smart. You're going to have to move kind of quickly in the new year, um, or you got to get creative. Yeah.
Yeah, yep, that's just it. They're gonna, I mean, as someone who's been kind of following and investing in real estate for about 11 years now, it's just become harder and tighter and more of a challenge the entire time. I got in just after you could get 40-year AM 100% financing on investment properties. Like right now, that seems like a daydream,
Yeah.
because it is
A
so
thing of
much
the
further than
past.
that. So, that vice keeps getting tighter and tighter and tighter. But here we are. People are still investing, as we can see. There are more investors now and more mortgages now for investors than any other segment of the marketplace. So people can find ways. It's just harder. They're going
Mhm.
to put up more roadblocks, and we're going to find more ways around those roadblocks. And again, if the government wants to suppress the rental housing providers, provide more rental housing. Right?
Yeah.
No
I
investor can
mean,
make money if there's no one to rent them out.
the real issue is that in order to fix this, it's going to take time. And that's what no politician can ever come out and say. We need time to build inventory. Those are the words. There's, it's pretty simple to me. You've got X amount of demand, you've got Y supply, you've got a deficit. So we need more. It's stop trying to stop people from living, and buying, and investing and growth. I just,
Right?
like we're not going to fix this overnight. This is going to take decades. So let's get started.
You heard it here first, guys. Ryan is going for mayor of Vancouver 2024.
I need a campaign manager, Dan.
Yeah, yeah. Moving on. We've talked a bit, or a fair amount actually, about the potential for suburban remorse, meaning all these people that, let's say, left downtown because they didn't have to go in the office, bought a much bigger property because they could afford it further away because they were working from home, got that nice home office built out, that kind of stuff. And for at least the first year, we thought, man, that could bite some people in the sense that they might get called back to work. And now we're 2 years deep, and everything's morphing, and there's more, Rona in the air than there's ever been. And let's also realize that a lot of these people that move to the burbs, let's use Mission, Chilliwack, or Abbotsford, for example, they outperform their property more so than they did in GVRD,
Mhm.
sometimes, by an additional 10-15%. So what does that mean? It means, okay, great. If they had to sell, well, they're up. So they can actually make that lateral move back and not be hit financially, at least in today's marketplace.
Mhm.
So no, it doesn't feel like that remorse is going to hit as impactful as we once thought.
I also think when we talked about jobs earlier, and I think one of the big retention strategies for a lot of companies moving forward is how do we keep really good talent? And by having a great work from home strategy or work from home plan for your employees, I think that's going to be a huge part of moving forward for any big corporation that has a multitude of employees. So I think if you know people are going to, or companies are going to want to keep their employees like are coming out of this with a bit more rah than they had going into it, that's for sure. And so now I think if they want to keep those people, not only are they going to have to do incentives, signing bonuses, retention bonuses, increased pay, but they're also going to have to accommodate wherever these people are now working from home. I think that's a reality. And I think that, people who have made 20-25% because they sold their condo in Vancouver and they moved out to Chilliwack, or they moved out, Abbotsford, or they went somewhere in the valley and they got those huge gains, they'll just find work out there. So yeah, I don't think you're going to see a huge suburban remorse. I just don't. I think people are going to like the money in their pockets.
I had a client who's working for Amazon starting next month, and they basically straight up gave him the option: Work from home, work from the office, hybrid, whatever you want, it's yours.
Mhm. Yeah, it doesn't surprise me. And I think that'll be the case moving forward. Technology, we can do that now, right? And I think that this is going to seem like a redundant conversation in a year from now.
Okay. Well, let's touch on one more big driver before we get into our prediction numbers here. And that, of course, is what's going to happen in the stock market.
Yeah. So, I mean, the S&P 500 this year rose by just over 25%, right? I mean, that's a huge, huge number. A lot of that, I think, well, not a lot of that, but some of that was driven by M2 money supply. Also, you had some huge, huge winners in the tech sector. Um, and then, we also saw a lot of people that got a lot of, what did you say earlier? 3-to-1 in terms of handouts from
Yeah,
the
for
government?
every dollar lost, the government handed out $3.
Right. So a large portion of that found its way back into the marketplace, whether that was in the crypto marketplace or whether that was in the stock marketplace. A lot of people, they weren't working. So they figured out how to do trading online. They watched some YouTube, and lo and behold, they opened accounts and they started growing the money that they put in, or that they were given if they didn't spend it on something else. So I think that was a fairly significant surge, but I don't think we're going to get that kind of money from the government in 2022. So that's one thing, right? Two, I think where we will see it though is we will see additional wages and signing bonuses and things like that. So we will see an injection back into uh, the stock market, but it won't be as crazy because there won't be that retail level that we saw this year. So I think it'll be closer to half the rate that it grew by. I think it'll be somewhere between, I know I've got 12 and 13%, but I actually think it'll be more like 10 to 12%. And I think this will largely depend on what happens with the interest rates in the States. I think the spaces in the stock market that'll do really well. I don't think that's going to deviate too much from what has done really well. So I think, again, the leaders will be technology stocks. Think gaming, crypto mining, DeFi space, semiconductor chip production, electric vehicles, and of course, that metaverse. I think we're going to start to see those continue to grow. A lot of those EV stocks, for example, they were just coming to market this year. Next year, they'll actually have numbers. So it'll be really interesting to see. I think actually healthcare is going to largely underperform because I think people are going to be sick of being sick. And I think you're going to see large return to value stocks because they've been deflated for the last little while. So I think, companies like Expedia or, travel companies, things like that, things that have been depressed for a while, I think they're going to be good buys, and you're going to see some good growth. Again, in the energy sector, I think you'll see some of that as well. So I do think there's going to be growth in the stock market next year. I think it's going to, again, largely depend on interest rates. But I think that's where you're going to see a lot of the action.
Okay, fantastic. I think that tees it up very nicely. That is a great sort of macroeconomic overview of the major driving factors of what we see influencing the real estate market in 2022. So we're going to combine that along with our expertise and boots on the ground feel with, of course, where the market is today, right? We obviously track the market very closely, and we know sort of our tipping off point. What is a snapshot of where we are today, and what's that going to look like in the months ahead, and how does that affect us? So off the top, let's talk about the sales volume. Of course, we have had a all-time high. We're going to probably echo that through every segment here, but all-time high sales volume, both nationally and provincially. We're kind of set up, or sorry, that was all-time high for 2021. We're in essence set up for that to happen again, but what's going to throttle that back, of course, is the inventory levels. It's a drought out there. There's no doubt. It has been for a while. It is only getting worse. The good inventory that comes out is going to get snapped up, but I don't think people are going to release at the rate they did in the last year. Our prediction here, somewhere in and around 5% less volume than 2021. Very elevated, really high, second or third all time, but I don't think we're setting a new record next year.
Yeah, I still think it'll be well above the 10-year average.
Oh, yeah.
like well above the 10-year average. The demands that we talked about aren't going anywhere, and the government's fueling it. Um, so yeah, I tend to agree. I think if we actually had inventory, Dan, I think we would actually set new all-time records
Hmm.
again.
I agree.
But we don't have the inventory. Um, so lo and behold, that's why we're getting a price push, right?
Yeah, so let's touch on inventory here because it has been the leading story for at least 6 to 8 months here now, and it is only going to continue. And here is why. Today, December 30th, we are recording this. At last check, there are about 5,780 active listings in all of GVRD. That
That's
is
terrible.
that is the lowest on record for any month of any year ever. The previous lowest all time was December of 2015 at about 6,800. Okay, so
More than 1,000 more homes.
yeah, yeah. So we're about 8% lower than that right now. And if you remember, okay, 2015 was the beginning of the last crazy price rush, right?
Mhm.
If we went into January of 2016 with previously all-time low inventory, and in the next 2 years saw the biggest 2 year increase in prices ever, up until, of course, what we just saw in 2021, we're lower than that. We are going
And
into January 2022 in an environment where prices could potentially spike again, like what we saw 2016, 2017, 2020, 2021.
and I guarantee money was more expensive then than it will be even by the end of next year.
Yeah.
That's the other piece, right? And like, it's
Yeah.
if you're gonna
So
feeling for those buyers already.
no, it's going to be tight, and again, everything's going to sell very quickly, as we've seen for the last 2 years. Um, I predict we won't surpass. We're about 1.9, 1.8 months of inventory right now. I think we're not going to surpass 4 months of inventory for the whole year. We just will not. That means we are going to be in a seller's market for all of 2022.
Mm-hmm. Yeah, I tend to agree. I mean, everybody thought it was going to slow down in November and December, and it got hotter, right? So, I mean, you can't ignore the fundamentals in the marketplace. You can't ignore this is the blood supply to the body. This is the if you don't have it, we've got big problems, right? And those problems are going to show their rear their ugly heads in pricing and in multiple offer scenarios and in a lot of crushed dreams. And it'll typically go to the highest bidder, right? As it always does. Um, where I think you might see a little bit of change in inventory, I just think that the pre-sale market are going to be the ones with the inventory. And I think also if OFSI comes out and starts slapping around investors, hey, you can't borrow this. You need a minimum of 30% down in order to buy an investment property. Whatever rules that they change, they typically don't affect the pre-sale market because mortgage rates aren't part of that. So, do I think you'll see higher absorption in pre-sales? Absolutely, and I think you're going to see that also because markets that we're about to touch here are likely going to need that inventory in order to continue their growth. So I think you're going to see a tremendous interest in pre-sale across the board, all different price points too.
Yeah, I completely agree there. I mean, if you remember just our last podcast, we talked about how the November absorption rate hit 69% in pre-sales.
Huge.
That means basically more than 2 out of every 3 pre-sales that hit the market sold that month.
Mm-hmm.
Massive. That's the highest I have ever seen that number in pre-sale. So,
So
oh yeah, fun one that we did last year. We predicted 5 markets that would outperform the GVRD average, and we were right on all 5, sometimes by as much as twice the rate. So we have 5 more markets for you this year. I'll start it off. We predict these 5 are going to outperform the GVDR average. We're actually doubling down on the first one. We predicted it would last year. It did. We're expecting it to do it again for 2022. That is Squamish. We are
yeah,
bullish on Squamish.
Squamish makes me squeamish.
Yeah.
And I say that because when you look at the last 10 years in Squamish too, It's the number one performer across the whole GVRD. It's the only one to compare close to it was Bowen Island. You can believe that. Over the last 10 years, they have gone up 10 years, 160%.
Oof.
Squamish. Yeah. So Squamish is a huge driver. I think when you look at what's happening in Whistler, I think it's got the potential for a new ski resort. Plus, the vast majority of the new construction that's taking place in Squamish is all for high density, right? So we're not seeing any new single family production in Squamish. We're seeing all condos and townhomes that are being built right now. And that is to deal with a growing population. So expect to see tight inventory levels, a lot of competition, and it's going to become a service base to the GVRD, as it's the same distance as our next one, which is Langley. Langley, I think, look, I had clients trying to buy townhomes in Langley this year. It's insanity. Insanity. You know, two to three listings for every 40 or 50 buyers, right? It's just, the inventory numbers are just so out of whack. I think the price is going to continue to go through the roof in Langley, especially in certain areas in Langley.
Yeah, totally agree. People are still, booking now on that SkyTrain going in, and investors are loving it. Homeowners are loving it. It's attracting a lot of end user, a lot of different demographics out there.
Great place to live too.
That's
It's just
it.
a great place to live.
So for number three, bit of an interesting one, and this is a neighborhood I kind of feel has been overlooked in the last year or so. Um, Burnaby North it's a beautiful area. There's some fantastic view homes that are there. Obviously, the location is great for all sorts of reasons, whether you're going north, south, east, or west. I feel like it's underperformed in the last year, and I think there's going to be a lot more attention put on it in 2022. So expect Burnaby North to just outperform the rest of GVRD.
That's Dan's value stock right there,
There
Burnaby
you go.
North. I tend to think Coquitlam and Port Moody will continue to do very, very well. Coquitlam in particular out of those two. I think Port Moody has seen quite a significant jump, but I think Coquitlam has property for different buyer pools as well. As low down in the 400s and as high up in multi-millions. So I think I also think the big reason why Coquitlam and Port Moody will continue to stay on the map is because they are attached to the light rapid transit routes that have been built. And I think generally speaking, if the tech sector and the growing employment sectors in the lower mainland are going to stay competitive, a lot of their employees are going to live along those light rapid transit routes. Depending on what happens to our investors, they are also ones to typically invest along these routes. So keep your eye on that.
Okay, and lastly, we've put two M cities together. We've got Maple Ridge and Mission.
Yeah.
Now, it was tough to put these ones in, I think, because these two have seen astronomical record-setting price appreciation rates for the last year. And so to think they're going to kind of continue, it feels hard to believe. And yet it's almost like we've created or built into this like level playing field where, the $1.8 million detached home average, it's cool if it's in Mission or if it's in Burnaby or if it's in Vancouver. It seems like there's just a price point. And because people can technically work from home a lot or work from wherever, we're seeing prices just sort of level up and sort of hit this balancing point.
Yeah.
And of course, Maple Ridge and Mission still aren't at the same prices as Vancouver, obviously, but they're outpacing them.
Yeah. The level of
So
growth is huge.
that's it.
Right.
They're catching up. So I think
That's
Ryan especially believes they're going to continue.
yeah. That's my position. I also think you're going to see renewed interest in things like condos. I mean, townhomes is already taking place, but I think you're going to see growth in those sectors there too, because largely single family homes inventory levels are just so low. But I think as newer communities, even though Maple Ridge is an old one, it's a new one with a lot of young families, and the same with Mission. in terms of construction, they're going to plan for higher density, right? So I think you're going to see less and less single family homes for sale in these areas. And when you look at the cost of a townhome in Maple Ridge and Mission versus the same townhome in even Burnaby North, you're looking at hundreds of thousands of dollars of difference. Yes, I understand the proximity difference, but as we move more towards a working from home environment, these tertiary markets are going to see far more growth as a result.
Yeah, I agree. It's they're setting themselves up for success, and of course, as we have transacted for a bunch of clients there in the last year, we just know the fever, the
Mhm.
pitch that people want to be out there right now, and
I
it's
mean, I'll just say to this point, like I was looking at Mission as an investment for myself this year. You can buy a pre-sale, 3-bed pre-sale, like the high sixes, low sevens for a 3-bed, brand new unit out in Mission. You can't even come close to that number in Burnaby, in Langley, in any of these other markets, right? So I think these markets are going to be playing a little bit of catch up to the rest of the GVRD, and that'll come with inventory as inventory and pre-sales hit these marketplaces.
okay. There you go. Those are top five, and there's a couple of bonus ones in there. So yeah, I'm excited to see how those perform this year, and if we were right 5 for 5 again, because it's a nice little tradition to maintain if we can. Okay. Rental rates. We don't dabble too much in the rental rate market in this city, but as investors, we obviously pay attention to it and advise accordingly. And as such, we do believe we are going to see rental rates that have already recovered essentially since pre-pandemic levels to continue an upward trend. We're going to see all-time high rental rates on average by the end of the year. It's not going to be blowing out 20% like we're seeing real estate, largely because with a 1.5% maximum increase rate, thanks. I say that as an investor. Obviously, if you're a renter, you want to slap me right now. But the reality is we're in a rent-controlled area, but still, based on the fact that these same people that are keeping rental rates low aren't allowing investors to buy as easily as before and still not building rental housing themselves. So what does that leave us? It leaves us a tight market. And in a tight market, when there's turnover, you will see rates come to market rate. And that just means that you can expect things to be higher than they are today by
We're
the end
we're
of the year.
all Yeah, Dan and I we've got an apartment building we've currently got listed in Shaughnessy, and a lot of long-term tenants in there, 11, 12-year sort of tenants. We've just started to see some recent turnover there, and we've seen sort of some fairly significant turnover in rent, and going from what were 10-year lows to back up to market rents, right? So and there's significant swings, and so don't think they're not coming. They are coming. When properties get more expensive, we need to service the debt. It's that simple, right? If we can't service the debt, these units won't be for rent. So anyhow, I tend to agree with Dan. I think we're going to see rental rates continue to climb with everything else.
Yeah, definitely. Okay. We love tracking the luxury market as well. And in 2021, it was almost certainly an all-time high as far as investor confidence or buyer confidence in that segment of the market, where we saw over double the amount of homes over 7 million sold in 2021 over 2020. There was something about 150 homes over $7 million sold last year. So much confidence in that marketplace. What's going to happen in 2022? It's going to remain elevated. It will not surpass that number. I think it's going to fall just short and be in second place, sort of your 125 kind of homes over 7 million mark.
I think another thing too that'll be interesting, depending on how you define luxury. The west side of Vancouver didn't see the level of growth, I think, that the rest of the market did, in terms of single family growth in the luxury market. So it'll be really interesting to see if Vancouver West performs better next year and continues to catch up as people start looking at, well, the east side of Vancouver has gotten so expensive, and that's largely because of the redevelopment potential in East Vancouver. But if you look at the west side, the properties on the more quote unquote sought after west side, they didn't perform in the same way. So it'll be really interesting to see if that market picks up, or if the trend has completely shifted away from Vancouver West, and we're seeing, Vancouver East is where all the action is going to be. One thing in the luxury market that I want to touch on too, in West Van, we also didn't see a huge amount of increase like we have done in the past. Whereas we saw in North Vancouver, we almost saw the creation of some new luxury markets that otherwise weren't there prior to this year. So interesting seeing that sort of reallocation of capital throughout the marketplace. And I think that's largely based on demographics and maybe where people want to be in the future, right?
Fantastic. Yeah, I totally agree. And a very interesting pocket to watch, as it's very protected. It's not quite as vulnerable as we'll see places like West Vancouver, for example. But yeah, we understand the demand there, and seeing just ridiculous numbers for even teardowns over there, for that demand of that dodo bird property.
Yeah, that's right.
Okay, well, you've made it this far. We appreciate it. Now it is time for pricing.
Or you fast forwarded.
Yeah, here we go. Yeah, we should timestamp these so you can just jump to the good stuff.
Yeah.
Let's get into it. We're going to do GVRD as a whole, and then we're going to break it down by each of the property types or asset classes. Off the top, GVRD, my prediction. It's protecting your asset with this prediction. GVRD 2022, 10%. You're going to see 10% increase next year.
I'm not too far off. I just about said the same thing as Dan, except when I did my averages, came out at 11.1%. So I actually think that I'm a little bit more bullish on the marketplace, but you'll see shortly that that's going to differ in asset class. So Dan, for condos, why don't you start with your condo prediction?
Yeah, so each asset class, I think next year is going to act very independently of one another. There's going to be very different drivers for each one. So condos are going to increase, and they're going to be, sought after because mostly of price point. It's going to be, your first time home buyers, of course, the investors that can get in before they get choked out by whatever taxations are coming. So it's going to go, but I predict condos to do about 8% in 2021. They're not going to be the leader, but they're going to see, fairly strong growth.
For all the same reasons, I think we're going to see 9%. I just think the inventory will be so tight in the other asset classes, in the townhome and in the detached, that buyers, if they want a place, will be left with very little option but to pay the rising prices in the condo market.
Yeah. So to get into townhomes. So the drivers for townhomes are going to be people that are moving up from those condos, your small to medium-sized families, growing families that cannot afford the detached, or they just simply can't get into one. I think townhomes are actually going to outperform the condos and detached. They're going to perform the strongest. They're going to be the most sought after. And I think they've got the most inventory to kind of supply that demand. Not great inventory, but enough to see a bunch of froth really happen in there. My prediction, 14% in the townhome market.
Yeah, and I largely agree. I'm 1% higher again, so the price is right over here. But I see 15%. Again, I think this comes largely off the heels of the unaffordability of the detached market and the necessity of the additional bedroom that condos can't provide. And I think people will go all over the GVRD for them now. I don't think that it'll just be in certain pockets where we see a lot of townhome heat. I think the heat across townhomes will be in every major marketplace that the GVRD has to offer. And I also want to just lump in there duplexes and triplexes as well, because again, on the east side of Vancouver, one of the main reasons why people are buying, or builders at least, are buying single family homes, is because we can subdivide them and put 2 or 3 dwellings on on these lots, and they've been blanketed zoned for that. So, um, I think you're going to start to see more and more and more of that asset class that we've been saying this for years, but townhomes and duplexes will likely become the driver in the future market. Um, it's just the most accommodating.
Hmm. Well said. Okay. And lastly, detached. Now
Mm.
we've seen or just come off a year where detached had all the attention and had the biggest price wars, had the biggest over asking prices, had the biggest amount of multiple offers we've ever seen for sure. Hard to think that these can go even further. This prices appreciations in the 20% that we saw last year. Can it go that much again? We don't think so. I think because there are so few detached and that number is decreasing, and those people that really want in are really just going to pay that money that is exorbitant and may not make sense, but they're going to hold it for 50, 100 years because they're
Or they
making
can.
generational.
They can buy it. That's the
There
other
you
thing,
go. Yeah, yeah.
right?
There's a smaller and smaller pocket of people who can, but the ones who can, they still are. That's why I think detached homes are still going to go another 12% next year.
Woo! I mean, look, I completely agree with you, Dan. Completely, wholeheartedly. I just think that the palette for 12% gain on what is already almost 1.9 million
Mm-hmm.
is just, I don't know if people will look for other derivatives to buy instead of a single family home. It'll come down to the necessity of requiring that home. I think. I think homes are still going to, detached market's still going to do very, very well. I think it's going to appreciate by 9.5%. Um, and I just think that, single family homes are already so expensive. And I think that that's probably why I'm not seeing the 12%. Um, it's already so expensive.
I know it feels hard to make these predictions, doesn't it? But again, I'm kind of relying heavily on the landscape we're living in and all these drivers. And it seems possible again. It really does. So we're gonna have fun tracking this. We're gonna bring you monthly updates. That is it for our numbers. But Ryan, why don't we cap this off with a bit more of an kind of outline, sort of other interesting aspects and things that we're following that we want to have people pay attention to next year because we know we are. And it's about where the real estate industry is evolving and how it is getting more and more incorporated within technology.
Yeah. And I don't know what's happened to my screen. So all you YouTubers, oh, hey, I'm back. Sorry. Um, yeah, I'll keep it quick. I think next year is one thing, but I think if I could just stretch it a little further, maybe sort of the next 2 to 5 years, I think what we're really going to start to see are some disruptive changes taking place in the market. I really think we're going to start to see a lot of cryptocurrency that's going to get traded for real estate. I think we're going to start to see NFTs on the back of wild custom homes, where what I mean by that is essentially the person who designs it or develops it is going to take a royalty every time that home is sold. Right. So a very special property. I think that's where you might start to see the introduction of NFTs. Or I think it might also be interesting is we'll start to see homes begin to transact on the blockchain. I don't know if that's next year or the year after that, but I expect to see this start to take place around the globe. There's going to be some leaders in that space, and they're going to want this to happen. So expect to see it. Lastly, there's this whole new digital world being built, the metaverse. And, it's not new. People are already buying digital houses and digital land on the metaverse. So what does that mean? I don't know. It could mean the whole new introduction of an all new asset class. If you look at Ryan Serhant, for example, he believes that 50% of all real estate transactions will be done with cryptocurrency, using cryptocurrency in the next 5 years, right? So is it all that abnormal to think that our industry is going to change? We are a dinosaur industry. So yeah, I think that being on the forefront and understanding what this means and the opportunities are going to be in this digital space. I think next year, Dan and I are going to have some people on our podcast. We're going to have discussions about what it means to own real estate in the metaverse. So stay tuned for that, because I think it's a space that we do not want to miss.
Fantastic. Okay, well, That's it. You made it through it. Thank you so much for watching and listening. Happy New Year. And it's 2022. If you are thinking about selling or buying, we're here to help. And we love what we do. We'd love to help you in this year. It's going to be an exciting one. Reach out anytime. Thanks as always, and have an awesome day.